European leaders recently walked away from their summit, bragging about having saved the Union, yet billions of bad debts remain. China is the most populous country on the planet and has the dubious honor of the world's largest vacant malls, vacant cities, and vacant amusement parks. Yet people insist that there's no property bubble. The U.S. economy grows sluggishly. President Obama says that unemployment will continue to decline. Yet at this stage of the recession recoveries, the growth should be larger and unemployment much lower than it is. Big banks have announced more layoffs, yet they each have said that things are fine. Down on Main Street at Armada Advisors, we see things differently. The one-year Greek bond is trading with a yield of 350%. Supposedly, the Greeks are only going to pay 50 cents on the dollar. If this is so, buying this bond here would be the best bond trade of the year. But the market suggests that investors will have to settle on less than 50 cents on the dollar. Separately, the main buyer of Italian bonds is the European Central Bank. The ECB is basically making the market there. So the Italian bonds should be yielding higher than they are. Watch out in Europe. The financial situation there ought to get worse within the next 6 months. The Shanghai Index continues to make lower lows and lower highs. This does not bode well for China. The index is sensitive to property declines, but real estate never goes down, right? Further declines there could impact the United States. The trouble in Europe and China will cause investors to liquidate foreign-denominated securities, which we've done at Armada Advisors, and go into U.S. dollar-denominated bonds and money markets. This ought to make the U.S. dollar rise, which would cause stock prices and gold to decline. People in long-term U.S. Treasuries and TIPS ought to do well initially in this situation, but beware. The Federal Reserve most likely will react in this environment by launching another stimulus program. This in turn ought to cause stocks and gold to stabilize and advance. Before it's too late, one would sell the Treasuries and TIPS, taking profits. This is because further down the road, the rest of the world will realize that the United States is on the same debt train as Europe, and our rates will rise. Meanwhile, a person can be prudent about his investments. There's little activity on bank-owned properties, but there are more houses in the foreclosure pipeline. Real estate could decline perhaps no more than 15%, which means some properties might be suitable investments. People seem to be spending for Christmas, but they are being very selective. High-end retailers could face some tough times. The value retailers ought to do better. The unemployment rate has fallen, but the number of manufacturing jobs have not increased measurably. The presumption is that companies have hired part-timers during the holidays. Companies will continue to raise prices to squeeze as much profits as possible. Some will not be able to do so. Quality companies will do better. Consider the rolling 20-year secular equity cycles and where we are now. Index investing is particularly unwise now. Select equities would be better. The case for fixed income investing, again not index investing, is strong, but owning bonds that have a high probability of maturing is paramount. If these things resonate with you, give us a call at Armada Advisors, where we are charting a better course.